Next up is me. And I'm going to talk about some of the corporate issues. The person that should be here is Teresa Skane, who is the corporate attorney at our firm. But as I mentioned, she's traveling to Antarctica, God knows why. So I'm going to try to pick this up and talk about some of the corporate issues. It's wonderful to work with Teresa because I can say, okay, Teresa, we need 3 LLCs. Here are the parameters. I hand it to her and I get them back in a very short period of time, done tremendously well and efficiently. So when we're looking at Marcus here and Kim, they have a company, they have a business. We talked a little bit, Dan talked about the recapitalization of a limited liability company. How can we maybe solve for these spousal lifetime access trust issues, the succession issues, and how can we put a plan in place with the current ownership structure where Kim wants to get income out of the business, we want to get Marcia the succession of the business, but Marcus is the primary business owner and will continue to be that for the foreseeable future. So option 1, a company purchase option. How can MK Fuels fund Kim's lifestyle, fund her income interest with the stock that is in her SLAT? Because we've already gifted the $12 million. The last thing we want to do is unwind the SLAT because we don't get our $12 million exemption back. So we need a creative solution to try to make the spousal lifetime access work for both Kim and Marcus and ultimately Marcia. So as we're looking at the LLC and we're kind of pulling it apart, we can restructure those interests to create the voting and non-voting interests. And in this case, a little bit of a twist. It's very common, no pun intended, to create preferred and common interests in a corporation. You have preferred stock, it has certain rights, dividend rights, et cetera. You can do the same thing in an LLC. So we're going to not only recap to voting and non-voting, but we're also going to create a convertible preferred non-voting interest in Kim's SLAT. And what we can do with that is assign income to it. A preferred interest can have a dividend right. It can have an income right. And so we can fund Kim's income needs from a preferred interest in the LLC. And in this case, we're contemplating 50% interest becoming half preferred non-voting and half preferred non-voting common. So Marcus retains his 50% interest, which is now 100% of the voting interest because none of the LLC interest left in the SLAT have voting rights. It's all non-voting stock now. Kim keeps the 25% convertible preferred non-voting interest, which carries a liquidation preference, which entitles her to distributions of profit from the company year over year. So here it is. This is the company buyout. The company paying Kim through her preferred interest to get her the cash flow that she needs, while Marcus retains 100% of the voting control. And now we look at the other 25%. And I talked about this earlier in the flexibility of drafting the trust, the SLAT. We want to have, and we did have, Kim with a limited power of appointment. So she can decide among the beneficiaries who is going to receive this interest upon her passing. So now she can bring Marcia in as the remainder beneficiary of that SLAT and use it as part of the succession plan to get Marcia equity in the company ultimately. So this is going to be a preferred interest that's going to be valued. It's going to have equity value and it's going to pay out to her. And when it ends, that interest converts back to just common stock, common interests. So you can put a plan in place using the LLC to weave in the company paying Kim through the trust and then have that interest go to Marcia upon Kim's passing, fulfilling her goal of becoming the equity owner. And that's already locked in. The valuation of those interests, remember, we're locked in at $12 million. So we can grow the company to $1 billion. She's going to get 50% of the company at a $12 million valuation already sheltered using Marcus's exemption. So it's a pretty good solution. And glad Teresa thought of it. So, option number 2, Marcus can buy interests out of the trust. So we can, again, restructure the limited liability company. We do that recapitalization, and that's just reformulating the operating agreement and the certificate. Kim's interest now is 1/2 voting, 1/2 non-voting. And now Marcus purchases the half voting interest through a promissory note with a down payment and payments over time equal to, again, Kim's buyout. We want to value it such that she's getting her equitable distribution through this note payment from Marcus. And that note payment is going to flow through the SLAT back to Kim. It's going to fund her income needs through the Spousal Lifetime Access Trust. The note can be secured. We're going to talk about life insurance to secure interests on Marcus, security agreement, assets in the company, including the patent. So we didn't really dig into this issue, but the question of who owns the patent will be a major issue in this because it was developed by Marcia, partly while she was getting her doctorate and partly while she was working for the company. So who has the ownership rights to the patent would be a litigious issue if it came to that. But in this case, Marcia is going to own the company anyway. So we didn't really dig into that issue. So again, now Kim has her limited power of appointment in the trust. So she gets her income interest during life with the note payments, this time not the company funding it, but Marcus funding it. And now we can again include Marcia in that 50% interest in the LLC as the remainder person on the SLAT. So again, weaving it together, it has some really, really interesting possibilities. And the third solution is a hybrid. Exchange 6 million of liquid assets in Marcus's SLAT for 6 million of the company interest in Kim's SLAT. Now, there are some tax consequences there. So you have to be concerned with basis issues because these are grantor trusts, but only for the contributor. So we're now taking assets out of one grantor trust of Marcus's and exchanging them with assets in a grantor trust for Kim. So you have to be very cognizant of the potential tax issues with this solution. The remaining interest in Kim's SLAT can be purchased by Marcus, again, using that same promissory note, or we can restructure it so that ultimately Marcia gets those interests in Kim's SLAT as part of the business succession plan. So those are three options: dealing with the SLAT, dealing with the LLC interest, dealing with the company inside of that SLAT. Creative solutions that can go in a number of different directions based upon cash flow and valuation. Those are the key metrics. So you're going to crunch some numbers. You're going to look at what the most favorable solution is. What about the building in Terrytown? They bought a new building. They moved the company up there. They're going to go into fuel cell production up in the plant in Terrytown. And they bought it for $2 million, mortgaged another $8 million, total of 10. So they have $2 million in equity. We want to put this out, get it out of individual name, obviously, and get it into a limited liability company. The question becomes, who owns the LLC? We could do a lot of different things with this in the equitable distribution. This could be another source of cash flow for Kim, because we could have her own the LLC, have a long-term lease with the company, and the company's going to pay rent to the LLC, which would fund her income needs. So that's one solution. We chose a different path. We're going to have this be Marcus's LLC, and it's still going to rent, the company's going to rent from Marcus. And now we have a tool, an asset that we can use to equalize the non-business children. It's been Marcia, Marcia, Marcia so far, right? But there are two other children that we have to account for. And this is an asset that we can use. It's not strictly a business asset. We lock it down with a lease with options to renew, but we can have the LLC go to the other two children with a cash flow. So it's another way to do the equalization on the estate planning side using a business asset, in this case, an LLC owning the real estate rented by MK Fuels. Now, once all this happens, you're going to have two owners, not a married couple, but a stepdaughter and a stepfather who are going to own this company going forward. So we want to make sure that we have the proper agreements in place, buy-sell agreements, so that they are bound to the company and bound to each other and can't sell out without the other partner. And in this case, it's a buy-sell agreement between Marcus and Marcia. We want to make sure that no third party can come in, swoop in, and buy out an interest. So we have rights that go into this agreement, drag-along rights and tag-along rights. So the drag-along right is if Marcus gets a private equity offer for the company that's 2x value, and he just can't afford not to sell, he could have a recalcitrant person in Marcia who wouldn't go along with the sale. So the drag-along right allows him to pull her into the sale. She has the exact same interest that he has in that situation. So she's going to get paid out the same way that Marcus gets paid out, but he can force her into the sale. Conversely, what if Marcus says, oh, I found a buyer for my 50%, but I'm not bringing you with me? She has tag-along rights. So if Marcus finds a buyer, she would have the right to be included in the sale on the same terms. So you have drag along for Marcus, tag along for Marcia to make sure that they're both protected in the event of a future sale. Then you're going to have some valuation issues. We're going to talk about life insurance in the business context and how do you solve some of these gaps in liquidity when it comes time for that buyout to occur, when that cash has to go to Marcia and the estate is going to get paid, or the business goes to Marcia and the cash is going to go back to Marcus's estate. Some of this could be used again to equalize the other children and to satisfy their needs. And Dan, you didn't use the term this year or this time, but you did in Albany. Yes, we call those, he called those children the trustafarians, the children who are living off of the trust fund and not part of the business and not working. So I kind of like that term. The other issue we have is making sure Marcia is vested in the growth of the business. So one of the things that Teresa and I love to do is to sit down with family owners, business owners, and go through all of the children in the business, out of the business, and find a way that the business owner can create equity for the child. But in many of those instances, they don't want to give equity yet. So is there a way that we can incent next generation business owners in an operating agreement or in a corporate structure, LLC structure, to make them more invested in the business, the growth, to take an ownership interest early without really getting equity with all the tax consequences? So we use something called a stock appreciation rights plan. And we've used this successfully with a number of companies that are our clients. It incentivizes Marcia, and we embed in the buy-sell agreement a right that Marcia has. So Dan is going to value the company at the inception of the stock appreciation rights plan. And if the company is worth $10 million or $35 million, that's going to be your baseline. We're then going to put a formula in place that the business revalues each year. And you can, very often a buy-sell agreement will have a formula valuation. So each year you're going to plug in numbers off the financials to look at the growth of the business. And Marcia is going to have a right to a portion of that growth. So as the business appreciates, she gets an interest in the company equal to a portion of that appreciation. There's usually a vesting schedule, 3, 4, 5 years, where she is going to get vested in that interest. But at the end of that interest, she could either become an owner or use it to buy out the other owner's interests, depending upon the situation and what Marcus's goals are at that point in time. So stock appreciation rights plans, we also call it phantom stock plans, are things that we use very often to incentivize business owners. And it doesn't have to be family members. One of the ones we did most successfully, there was a son in the business and another gentleman, same age, who was a key person. And it was a construction company. And this guy bid jobs better than anybody else. So he was getting all kinds of work at a very good margin. And so the owner wanted to incentivize both his son and this other employee and make them equal owners ultimately as partners. And so we put that plan in place with a 5-year vesting schedule on a stock appreciation rights basis. They tripled the value in 2 years. So he said, I'm done, I'm retiring. And so we executed the buyout after 2 years with the kids taking on a promissory note and buying him out over a 10-year time period. So they have worked very, very nicely in that context. And so we like using those.